Well, a huge thank you, gentlemen, for kicking off the day. Now we're talking about digitizing the world's largest offline market. And I'm really excited to bring you Ownera's Ami Ben David. Take it away.
So today I'm going to talk to you about private markets. But before I go there, I want to share with you a unified theory of digital financial markets, or really a simple model for making financial markets digital in full. So if you look at financial markets today, our financial markets are built on accounts. You have a bank account, and under the bank account, you might have sub accounts with each type of use case and assets like currencies and shares and so on. And transacting between those accounts, all the transferring, paying, investing, and so on, that is our financial ecosystem. And it's been built over the last 50 years. I call it, a lot of people in technology know the concept of technology debt. It's a 50-year technology debt, a spaghetti of platforms. I say 50 years because Swift, one of the network, was actually launched about 50 years ago. These are just a lot of networks that try to connect incompatible accounts, trying to trade across all the financial institutions and network and so on. And now we're looking at crypto and we're seeing a new way, a new idea, a digital way of doing things. And the concept that's kind of taking over the institutional market right now is that fixing the old spaghetti is possible, but it's going to take a lot of time. And the market is just leapfrogging straight to digital. Like some countries in the past bypassed landlines and went straight to mobile, we're going straight to digital. So what is the unified theory of digital financial markets? It says something very simple. It says every account will eventually be a digital wallet. Okay, in the same way that the internet, every device has an IP address. Think about every account in any platform, any bank, any exchange that you work with for securities or for commodities or whatever it may be. Think of every account as a digital wallet. And what is a digital wallet? How is it different from the accounts that we know? So first of all, a digital wallet is a cryptographic address. So a ledger can assign value and transact directly on them. So you can have one ledger talking to 10 different addresses, and each one of them sitting on a different bank. And for the ledger it doesn't matter, because the ledger can see all of them. And we see this in crypto ledger, and we are going to see this also in tokenized ledgers as well. The second element of why a wallet is better or different than an account is that it can allow an owner or the custodian to transact by simply signing. When they sign with their secret key, there's a mathematical proof of their intent. And put those two things together, and what you get is a world where if all accounts are digital wallets, then all transaction in and between all the assets will be direct and instant. And I think this is worth kind of thinking about a little bit. It means that there are so many transactions today that would go through 10, 15 intermediaries between the destination and the target. So many things that cannot be done because there's no access and no distribution. And I will talk about specific use cases for this in a few seconds, but this is quite big. The transition from accounts to wallet is removing massive layers of intermediary complexity, reconciliation, margins, delays, error, risks, and costs. And that's kind of on the optimization level. But not only that, it enables new markets. It enables new access to markets. It enables new things that we're seeing, for example, in DeFi, all sorts of collateralization, liquidity pools, and a whole new world of things that are only available when you move from accounts to wallets. And it can be done gradually. You don't have to go through, an exercise of kind of doing an operation and trying to fix the entire 50-year-old platform, but you can add wallets actually on the side. Now, what does it mean to financial institutions? Financial institutions today, those that are looking at digital seriously, are starting to understand that the battleground for the future of financial ecosystem is actually in who can deploy the best wallet to the best client and connect them to the best networks. This is what it's about. Because at the end of the day, when transactions on wallets are happening and they're cheaper and they have more features and they're more capable and they can do more things, if a bank is stuck with the old kind of accounts, they will not be able to compete. So the banks that will start and get those clients on wallets will get an advantage. And that's true also for newcomers who come in and, within weeks and months sometimes take huge market shares and valuation out of old financial institutions. It is also about valuation. The financial institution that will win in this battle will have the valuation significantly, in a different ballpark than those who won't. Now, this is not a pipe dream. This is already starting to happen, and the financial industry is working together, and it is starting with private markets. Now, this is a little bit unintuitive, because you would think that because digital wallets came from crypto, then we start with crypto. But the reality is that a lot of financial institutions and regulators are not yet fully comfortable with deploying crypto in mass. I mean, they're giving access to crypto through securities, but not direct kind of spot trading and so on. This has not arrived yet. Okay, so that's not starting from there. And also, public markets, another area we could go to, it's already electronic, so the problem is not that big. But in the private markets, there's no 50 years history. There's no digitization at all. Things are still done in Excel sheet, phone calls. It's a massive industry, much larger than the public markets, with almost no liquidity. So it's an ideal place to experiment with digital. So sometimes innovation goes to the most unlikely places. But what we're seeing today is that most, if not all, major financial institutions will deploy wallets for private markets before they deploy wallets for crypto. So what is the effort? The effort I'm talking about is a group of 70 leading financial institutions, major banks, asset managers, exchanges, major fintech companies, and blockchain companies that came together under GDF, which is a nonprofit organization that promotes digital transformation. And we created a group called Private Market Digitization Steering Group, led by my friend and partner, Anthony Woolley. And in that group, we're trying to solve the problem of allowing every wallet to trade with every wallet, and every wallet to trade with every ledger across any underlying distributed or centralized ledger, any settlement currency, any custody, any issuance platform, any regulatory. That's a large task. And to do that, we defined a network, an open source protocol called FinP2P. FinP2P is an open source decentralized protocol. It's not a blockchain, it's a routing protocol that enables instant trading across any asset class and any ledger. And if you want to know how it works, just go to FinP2P on Google, and you'll find it's the first reply will be FinP2P, and you can dig into the specifications. Now, how does it work? How can we connect everybody to everybody across the board all the time? So FinP2P, you can think about it as a big pipe in the middle, where the nodes in the pipe are financial institutions, okay, and they're connected to each other through nodes, and the nodes are identical. They're all FinP2P nodes. Now, you start connecting to the big pipe every ledger through smaller pipes. So you start with the digital assets, which you connect with a pipe to the big pipe, and you can bring in every digital asset. It can be Ethereum, USDC, but also digital dollar, CBDCs when they come, various stable coin, and even treasury tokens and so on. So any digital asset that could be used for trade or settlement. Then you can bring in any asset that is tokenized on public blockchain. Then you can even go to assets that are tokenized on private blockchains, and you connect also to assets that are on any enabled securities ledger. So now you have pipes connected to the big pipe, and now you start bringing the wallets. So Bob's got a wallet connected through their financial institution, and as you can see, if Bob is wallets number 100, then wallet number 100 will hold some USDC. They will hold some shares in this company and in a token that's going to the moon, and in some other company as well. And in the same way, you also have Alice's FinP2P wallet, and Alice can trade with Bob. They can exchange, they can do borrowing and lending and everything that you want, all on one platform. Now, if you've done that, then you can achieve what I talked about before, which is every transaction instant and direct. We so far released 3 pillars of FinP2P. The 3 pillars include, first, primary distribution, which is the ability to tokenize any asset in the existing world or digital and distribute it for sale for any wallet that sits on the network. The second thing that we launched was secondary liquidity, the ability for people to exchange IOIs, indication of interest, to say what they want to sell or what they want to buy, and have this transact and instantly settle. So this is different from the kind of 50-year-old platforms. In the new world, you can also settle instantly straight to the ledger. And the last one, which is new and super exciting, is collateralization and DeFi. Think about a simple use case where you have, let's say, shares in a company, and the company is not public. You can't sell it. You can't borrow money against it. You just sit on it. But if you have collateralization DeFi, you can practically go to FinP2P, click a button, get money. The shares are going to be pledged, and then when it's done, you can get your shares back. So those are the three pillars. In order to look at what we're going to do now, we looked at what is going to happen in the private market in the coming years. And BlackRock issued a statement recently where they said that they believe the private market will grow in portfolios from 5% to 20%. That's 4x growth. It's a super attractive market right now, and you can't grow 4x without digitization. It's just going to be very difficult to do practically. And what we're going to do in Q1 is we're going to launch FinP2P with several of the banks and asset managers on the FinP2P group. And we did this analysis, and I want to take you through this analysis because it's interesting, I believe, and I'll try to make as much of it in the time that I have. So what you see here are the three pillars: the primary distribution, secondary liquidity, and collateralization, and 4 asset classes that we can tokenize and digitize with a platform like FinP2P and digital wallets. In each one of them, we try to understand, is it optimization? Is it a market that works well, but digitization can improve it slightly? Is it transformation? Transformation is 5x to 10x, a market that exists, but it's so inefficient that by digitization, you can get a 10x on this market. And the last one are markets that are blue ocean, completely new markets that were just not available or possible before you digitized the wallets and the networks. A good example is pre-IPO shares, unicorns, if you will, $2.5 trillion market with hundreds of super, exciting companies where, the stat is that the last round from, the value from the last round to IPO is 7 times bigger than the value after the IPO in the first 12 months. This is a very attractive market. And in this market, primary distribution, we put it optimization because today unicorns can raise capital. Yeah, I mean, we can make it more efficient, we can give more distribution, or if the market goes bear, then people will stand in line to get distribution. But for now, it's optimization. But if you look at secondary trading, in secondary trading market, extremely inefficient market where you can have 100 people on a cap table of a company and 100,000 people want to get in, right? And there's no way for them to trade properly. Trades take 3 months, 15% completion rate. If we move to 100% completion rate in one click from wallet to wallet, that's 5x on existing supply and demand before any additional. And then collateralization. The collateralization is, again, the example that I gave before. You're sitting on your shares as a founder. You could actually borrow some money and buy a house without having to sell the shares that you will believe will be worth much more next year, and you don't want to sell them right now. Let's see how much time I have left. I'll cover just one or two more because I think these are interesting. But you can take this kind of value that you get from digitization across the board to pretty much every asset class. So the next one I'm going to talk about is I'm going to switch to institutional real estate. Institutional real estate, that's not a $350 trillion real estate market. Just talking about professionally managed real estate, a $10 trillion market, of which $6 trillion is private. Well, this market has no secondary liquidity. And because it has no secondary liquidity, you can only sell to pension funds and people that don't care about liquidity. They care only about yield. But if you could have liquidity or collateralization, then you can sell to many more people. And you can package products that give 4%, 5% yields in a year in a market where fixed income is negative. You give the bank $100 million, you have to pay them $2 million at the end of the year. So this is a super attractive product that can work really well. Similar market in private equity funds, where the market is $9 trillion, but secondary market is only $90 billion. It is 1% a year, almost extremely inefficient market, where digitization and collateralization can at least triple the market, if not more. So I'm going to stop the presentation and just come back to say that I think the move from accounts to digital wallets is at the heart of the digital revolution. And yes, we've learned a lot from crypto. I think that the next panel is actually going to be talking about what have we learned from crypto. So I think it will be a good segue to move to the next segment. But I wanted to share today the kind of the big plan for a unified theory of digital private markets.